Our next guest says there's 3 reasons the markets will likely test the lows. Tony Dwyer is the chief market strategist at Canaccord Genuity. Oh my God, he looks exactly like he did 25 years ago on Squawk Box. Tony, how are you? Good to see you. You're supposed to say so to you, Joe. I don't know if we got.
He's either on mute or something.
I don't know.
Did they actually cut his mic?
We're gonna have to read his list if we don't. How's our audio with Tony? Tony, can you try again?
So do you, Joe.
There you go.
Okay.
Perfect.
There you go.
Well played.
Sorry, I was just checking.
So Tony,
Yeah,
I saw last time that you were on, you did acknowledge that this whatever we just saw in July and from June 16th, there was more oomph to that move than you were expecting. But I think maybe there was some vindication in the end of last week and today for your more bearish perspective.
Well, Joe, it's interesting because the momentum indicators were extraordinary. I think everybody on Wall Street at this point has heard that we've retraced 50% of the bear market decline and that more than 90% of stocks in the S&P are above the 50-day. And that is absolutely true, and that's not to be ignored. But when I went back and looked at the data, I found something really important. I don't believe a single one of those periods where you had that kind of bear market and then that kind of momentum turn higher, all of them were associated with a Fed that not only might have thought about pivoting, but actually pivoting and was lowering interest rates. So that really is the solution here to the dilemma on the economy is worser data creating a faster real pivot from the Fed.
Because that was, I don't know whether you heard our previous discussion. We're a long way from where the Fed could be forced to not pivot. I mean, if you go back and we worry about the 70s and the 80s and the stop-start that the Fed did back then, where it thought it had conquered inflation, and it hadn't, only to come back with a vengeance till Volcker came along and really drove a stake in it. So these guys, they know that, guys and gals, and they're probably ready to not blink on raising as long as we're anywhere near 8%, 7%, 6%, 5%. When would you stop if you were the Fed? If they really say 2 is the number?
Joe, I think we're looking at the wrong thing, maybe. We're looking at inflation. On the core PCE, somehow the Fed has let the narrative get away from the PCE, which is a more stable version of inflation and their primary gauge. And somehow they let the CPI become the one. That peaked 3 months ago. But again, I don't know that it's inflation. That already peaked and is coming down. You can see it in durable goods for sure. Non-durable goods, obviously, with gas and clothes have come down. But I think what's really going to cause them to shift, we're in an election year, midterm election year, as you know. The economy is slowing down by all measures. So what we may want to watch is the second mandate, which is full employment. If you look at the National Federation of Independent Businesses Small Business Hiring Plans Index, it leads the unemployment rate by 4 months. It's coming down hard. And when it does, you typically get a lift in the unemployment rate. So as we get past September and October, I think the test of the low comes from, the pendulum going from good news is bad news. We're right in the middle now in the sweet spot that caused the summer rally, that caused us to expect a summer rally was bad news is good news. It means a less onerous Fed. But eventually the pendulum swings into bad news is bad news. That should help create a real pivot from the Fed as unemployment picks up in an election year and the economy trends toward recession.
So, Tony, when I look at the calendar, I think of Jackson Hole, September 13th, midterm elections. So September 13th is the CPI print. Is this what I should be focused on? I know that you had said it's unemployment versus the CPI, but do I have my calendar right as far as what the market should be doing and where it should take its cues?
Well, Steve, I think if you do get a real good print on inflation, maybe it gives a bump to the market. But think about this. The S&P 500 in the broad market is down from where the CPI print was. Defensive sectors have led it. The dollar is higher, and interest rates are higher across the yield curve. So the idea that somehow a fabulous print is going to magically create this, return to the bull market again. Our core fundamental thesis. Listen, we've all sat here and watched every day with the volatility and algorithms and quant. I change my opinion in my head about 40 times an hour. It comes down to the data. And the data is very clear. The market correlates with the direction of earnings. Direction of earnings is driven by economic activity, and that's driven by money availability. How do you get money availability coming into the market when we're at peak employment and money supply and real liquidity are so poor?
Tony, we're gonna have to leave it there. Pleasure seeing you. Appreciate it.
Thanks for the compliment, Joe. That was great. You too.
Yeah. Okay. Thanks. I figure we could. Both of us, if we both say it, people might buy it that we're both sincere.
Okay.
We are. Thank you. Let's. Right. Yeah. Nothing's changed with you, Tony. That's a good. All right. Thanks. Let's trade this with Karen Feinerman. Hey, Karen. What do you make of the action today? It was. I got a green tie on, but that's about it. That was green.
Yeah, that's about it. That was green. I mean, the VIX I thought actually would have been higher today. There didn't seem to be anything panicky about today, even though 600 plus points down is kind of a bit of a move. But if you step back and look at the magnitude of the rally that we've had, it really isn't very much of a dent at all. And it actually, I think the VIX is just starting to get going, and I think there's some more downside. But I do think the numbers coming out tomorrow are really important. I think PMI is not important as CMI, but I do think it will give us some kind of clue. And now that we're getting to the end of earnings, we're going to just sort of be, buffeted by whatever tides are out there, not earnings. So it's going to be macro stuff, which isn't my favorite thing as a value investor, but we're kind of, that's where we are. So I kind of think that the trend will be down. We've run so far so fast, a little more down wouldn't hurt us.
Well, I don't know what the new normal for the VIX is, Karen. That worries me because, I don't know, we haven't got to those elevated levels through this entire sell-off. So it makes me think you'd need something really violent to get it to 35 or 40.
But should we have been south of 20, and which is where we were last year? And that's why I just think some of the market dynamics are also things that we need to be paying attention to. If you look at S&P future shorts, non-commercial shorts, they've only been this high, 2 or 3 other times in the last 20 years. So again, if you look at the speculation against this market, if you look at the wall of worry, and if you look at cash levels, they're still pretty high. For a lot of people, those are setups where actually, if you get some decent news out of Jackson Hole and in a posture that maybe what people want to hear, maybe it's not pivot, but maybe it's less aggressive, it also gives you a decent shot for this market to bounce.
Very good.